So you are pretty familiar with this Fibonacci retracement technique, right? Most of you know that have this sense that whenever there's a leg, we put a Fibonacci from here to here, and we wait for the price to retrace back to the 618, the 786 point, the 0.886 region. Now, this is a self-fulfilled prophecy for mostly everyone that trades Fibonacci these ways and waits for the retracements. But do you know why this works? That there is a psychology behind why the markets move this way, why there is an expansion, and why there is a retracement to some of these levels 618, 786, 886, something in between here as well. So this lecture, and from starting from here, we will be covering why price moves the way it moves, the algorithmic delivery of price, the objectives of price. The Fibonacci settings are like this. We have the 618, the 786, the 236, the 886, and there is also zero point 0.5, which is not really a Fibonacci number, but people also use this to, get back and see the price where it has it like rebalanced 50% or some sort. So today I'm going to show you why the psychology behind Fibonacci works and how you can utilize it to your advantage when trading any sort of market, any market. This works on every market. This works on higher time frames. This works on lower time frames. It works everywhere. It's fractal. Let's get right into it. So, I don't know if you guys are familiar with this particular graph, chart, infograph, whatever you want to call it. We call this the Wall Street cheat sheet, the psychology of a market cycle. The market cycle is a very important term for us. You can find this, you can just go and search Google and search Wall Street cheat sheet, and you can find this. I will also upload this in the Discord within this within the link of this lecture. So here is how the markets behave. Whenever we start, let's say this is some sort of a low, this is a starting point, an origin. We start from here, and these are the phases of how people feel during every phase. This is their feelings and how they feel. So once we start, well, this is also a disbelief that hey, it's like we are actually starting to pump again. And after some time, once we start making higher highs and higher lows, there is this hope. Hey, a recovery is possible. So we go even higher, we start making higher highs, and there is optimism in the market like this rally is actually real. And then we go a little bit higher, there is belief, time to get fully invested. People are like, hey, hooray, we are actually going to the moon, and this and that. Then there is thrill. I will buy more on margin. Gotta tell everyone to buy. So this is almost like the peak of the cycle. The cycles that you guys hear about, the Bitcoin cycle, this cycle, business cycles, every cycle. This is what the cycles and the psychology behind them means. So almost the second last stage, that's the thrill. When everyone is almost about to lose their minds. Then we have the euphoria. The euphoria is the top. That's the top. Everyone and their grandma is investing. They are telling everyone else to invest. Buy this token, buy that coin. Invest in NASDAQ, invest in this, invest in that, invest in this stock. But as you know me, there is always a but. The thing is, this euphoria is when everyone piles in. The non-knowledgeable persons, the people that don't know, the less informed ones. This is where everyone starts buying. And The institutions that brought the price from here to here, they are selling. There is also Dow theory. There's also the Wyckoff schematics that come into here, but I'm not going to make that this really confusing. All you guys need to know is just the some stages. Not even that. You don't even need to remember their names because the names are unnecessary for us. The only thing that matters is this sort of PA. We start, we go up, we create some sort of a top, and then we what do what? We break the structure to the downside. The first pullback, the pullback that breaks structure over here. And then after the top is in, the euphoria is in, we sell off pretty vigorously and then we come back up. Now this is a retest, but in case of the market psychology, we call this complacency. People are thinking we just need to cool off for the next rally. Of course, this is just a retracement and we are going to go higher. But what happens is that we don't go higher. This was the top. And after complacency, there comes anxiety. Anxiety is when we start creating another low, suggesting that this was actually a top. Now people start to be anxious. Why am I getting margin calls? The dip is taking longer than expected because, again, this is not a dip. The cycle was over here. Then we have denial when we go deeper, that there are more drawdowns. Denial. My investments are with great companies. I bought Tesla, I bought Nvidia, I want this, I want that. Imagine the dot com cycle, the dot com burst. And before that, there have been lots of cycles when people have thought. I mean, the most recent ones on the Bitcoin, the 2017 Bitcoin boom, the 2021 Bitcoin boom, and then there were the cycles. Now, I'm going to show you this to you on the charts as well. Don't worry about that. But for now, you need to understand the theory behind the psychology of the market cycles. So then we have the denial, and we go further down, and then there's panic, the capitulation, the panic. Still, everyone is selling. I need to get out. That's when panic happens. Capitulation is when most people that have bought over here, over here, over here, they start selling in fear. Now, this is where greed and fear, they both intertwine. They both work in tandem. And that is how and why the markets move the way they move. And this is a cycle. We start, we retrace, we come back, and then the next cycle starts. Then there's obviously anger. Anger is like, well, who sold, right? Who sold? I'm lost. You are down almost 80-90% from the highs and you're just angry. And then after anger, there is that one final phase called depression, which is worse than the anger. This is the last low before a new cycle starts. This is the last low. And this is where most people are either liquidated or they sell. Like, probably most of the people that bought over here sell over here because it could be some news, it could be some bad news. I mean, again, it doesn't really matter. What matters is that they sell. And this ignites the next cycle. Depression is the last stage. Disbelief over here is the first stage. What do we see over here? It's a break of structure to the upside. This was a break of structure to the downside. So this becomes, the disbelief becomes a market structure shift, which signals us that, hey, the next cycle is about to start. Now, all of this, you don't need to know all of this. All you guys need to know is how does the market cycle look like on the charts? How does it work? Now, I'm going to show you real case examples of cycles on Bitcoin, gold, NASDAQ, stocks, anywhere and everywhere. Anything that is mature enough to be charted, any asset, it has its cycles. Let's go to the daily time frame on BTC and we will discuss this. Actually, let's just go to the let me zoom out and BTC, the index of Bitcoin, all-time history index. It has everything on Bitcoin. Now, you might see that I have I have some things over here that are already marked from my previous teachings, but I'll take you through the whole example again. So this is the first Bitcoin cycle, the first one. This is also a cycle, but let's just start from here. So we started from here. Now, forget about all the phases. They don't matter. What matters is that we started, we went up, we created a top, and then we came down, retraced it all, around 80 to 90%, all of it. And if I post this over here, you would see pretty much the same thing. A top, a blow off top, euphoria, and comes back down, retraces it all until what point? A point over here when there is a market structure shift, which signals that, hey, this is the disbelief when the next cycle starts. Now, the thing is, I showed you the Fibonacci's in the start of this video. Now, where do they come in? This is all an impulsive leg, and this is all a retracement on a cycle. And this is why, my friends, Fibonacci retracement works. Let's get rid of this, and I'm going to show you exactly how you can use the Fibonacci retracement to judge the market cycles on weekly, monthly, yearly, and even 5-minute, 15-minute, 1-minute, 30-second charts. This, what I just taught you, the psychology of the market cycles, it works everywhere. It works on every time frame. So let's start. We have the Fibonacci retracement tool. This was our low. This was our high. Where do we retrace? Almost down the 886 level. This was actually probably a 90% retracement, but what do you need to expect is, so this was a 93% retracement on the first cycle on Bitcoin. So that's like, it comes to our levels, the 786, the 886, and then the next cycle starts. Now let's look at another cycle, the next cycle on Bitcoin that starts, and it's obviously started from this low and went till 260. So it was almost like huge. So 280 and till the high. And you will see that it's from there back down to here. This. Almost a 786. Went up there, came back down to 786. And then the next cycle starts. Now, the next cycle is obviously much, much bigger than the previous cycle. But we started from here all the way to 1250. Where do we come back? The 886 region, the 786 to 886 region. And here we shift structure again, and this is where our next cycle starts. From here. The cycle just keeps getting bigger and bigger and bigger and bigger, but the psychology remains the same. Now, from there, actually, wait. From there, let's just say this was the one, all the way to this point. Same thing. 786, almost to 886 retracement. Almost there. The whole cycle does this. And then we start getting a break of structure again and all. This drop was because of the COVID-19. And what happened then, we broke the previous all-time high and we posted an even bigger cycle. Start from here all the way to there. 786 retracement, all the way to 786 retracement. And now the next cycle has started. And obviously it's going to be much bigger than the previous one, and you can see that we are actually very, very high. But wherever the cycle ends, I believe it's going to be around 138 region, 138 to 145. We will expect Bitcoin to do something in the region of this. And then there is going to be a retracement all the way to 786 region. This point is your buy zone whenever price comes back, because it will eventually do that. If you think Bitcoin isn't going to see 50, 65K levels, you are wrong. It will see that. Just be patient enough. So this is the market cycle on Bitcoin. And I've just shown you how the psychology of market cycles and Fibonacci, they work in tandem. This is why basically why the Fibonacci sequence, the Fibonacci retracements work. If you want more examples, I could show you tons of examples, like gold. Let's talk about gold. This was your first cycle, I believe. Let's just do it from here, right? Sorry. Here to there, 786, boom. And from there, oopsie, from there to there, the 0.5, the cycle is still going on. It's a super cycle. Don't get into what that means. A super cycle is also a thing. And it can basically just be a very, very long cycle. Since gold is a very, very mature market, its cycles can exist for decades. And for that, I would like to show it to you. Like, look at this. This was the 76th, like 1976, all the way to 79.80. That was a 4-year bull run on gold. And then it took from March 1980 to almost 1999. So that was a 20-year consolidation, low, bottom, like the whole market psychology thing. And it took gold almost 38 years to break its previous all-time high. So gold can take ages to, sometimes it might just outlive us, but this is how it works. The more mature a market gets, the bigger a market gets, the more time it will take for its market cycles. But now that you have a theory on how and why it works, we are obviously not here as positional investors and waiting years and months, like months and years, to take a trade, right? We are day traders, swing traders, scalpers. And how do you apply this specific knowledge for yourself in your trading journey? Well, since I told you that it's all fractal. It works on every time frame. I'm going to take you back to our previous lecture's notes, the exact points which we marked, right? And I'm going to show it to you now that this can be translated on to your lower time frames. Now, instead of zones, what we will do now is that we will use the Fibonacci ratios on the lower time frames, on the higher time frames. So let's first look at this point. Apply your Fibonacci statement or retracement 786, 886. Now, most of the times on the lower time frames, you will see that the 618 also plays a key role. And on the lower time frames, it's not necessary for us to visit the 786, the 886 region or anything. The most optimal points of retracement are actually 705, the 75, the 786, and the 618. I don't really use 618, but I use it for just gathering the market cycle data because sometimes the price is pretty aggressive and it can just bounce from here. But most of the times, the 705 to 70, the 786 region, this is the golden zone for price to come back and then go back up. And you will see it happens most of the times. 618, 705, 786. My goal of teaching you this is to not trade from this. We will be trading on the zones, this particular zone. We will be trading on the zones. You need to understand why this works because you need to know whether the objective of the price delivery to somewhere has it been achieved and are we ready for our next cycle. So if you're bullish, you obviously expect continuations higher. But where do you know from where is the market likely to go back up? For that, we use this, the theory of market cycles, the emotional market cycles, the psychology of the market cycles. That is why we use it. Now, once you start getting better at the systems, the GTS, you won't be needing this tool. But for now, for your understanding, you need to understand and know and believe why the markets work, how they work, why the price is delivered the way it's delivered. And this also doesn't like it's fractal. Again, you saw it come back from this low to this high, retraced 705, 786. So we had this low that broke this high. Apply your Fibonacci, comes back to 786, 886, and then goes back up. Apply your Fibonacci. So this one actually failed, but you get the point. It comes back, and if the price doesn't really want to go up, obviously it will break. Because why? This is actually fulfilling the higher time frame objective of this whole market cycle, the bigger market cycle. Now, this is why I don't actually use Fibonacci retracements for trading because you need to know what the object, and it can sometimes be misleading and confusing because if you only start using Fibonacci retracement and start buying every dip over here and somewhere you'd be taken out because you don't understand the objectives of the higher time frames. This order flow is on the 4 hour, but this leg was on the 15 minutes. So the higher time frame is always the bigger time frame, the one that will have precedence. So if this fails, you know where we are heading. Why? What happens over here? Again, market structure shift. We know that 15-minute or 1 hour has switched bearish. And where are we heading now? This this was your euphoria, structural shift. This becomes your complacency, and it starts going down, filling what? going back into the depressional phase. And from depressional phase, we'll see some sort of a market structure shift, which will give the disbelief, and it will be the origin to the start of the next cycle. This is how you have to see it. The price has objectives. Every leg has its own cycle. And there are cycles within cycles. Everything, obviously, we know that the price is made up of fractal nature. There are multiple different smaller time frame candles and a bigger candle, but all of them react the same way. They go up, they retrace, they go up, and so on and so forth. So in this case, once you start shifting the structure, you can see from here, what does the price do? What does the price do? Comes back up and now fills this leg's market cycle. And obviously there is a zone in there as well. And you will see that these two actually rhyme together. But we are not talking about zones for now. However, it fills this leg's cycle and creates a new cycle. And this whole sequence of price action is just a retracement of this leg's complete bullish cycle. And once price comes here, we know that on the 4-hour time frame, once we have a disbelief, once we have a market structure shift, we know, hey, price has filled its objective, it has completed its market cycle, and now we should expect what? We should expect the next cycle up. And this is exactly what happens. We create higher highs and higher lows, and we start going back up. Now, during our time on the 4-hour, we obviously have the smaller legs, which obviously have their own cycles. From this low to this high comes to 0.5, doesn't really complete the whole cycle, but this is obviously it. The second one, from this low to that high, comes back almost to the 786 region, completes its cycle, goes back up. Now we have this leg. What does it do? Completes its cycle, the 618. Now for me, the cycle is completed once we hit the 618 to the 7, like anywhere below the 618 region, this, anywhere in this, actually this one. So anywhere in this, the cycle is complete. Once we hit this, change the character, there are more than likely chances that we are going to create the next cycle or the next leg, whatever you want to call it. It's just how you want to see it, how you want to give it a meaning of to understand it. So this is basically how this just works. And over here, of course, we see this. So this one actually just came to almost the 0.5 of it. Actually, no, it was, yeah, it hits almost 0.5. So one more thing that you guys need to remember is that the point of rebalancing. It's a market phenomenon that whenever we pump, we leave, we have some impulsive price action. The price should actually come back and retrace to at least the 0.5 of the whole leg, which basically rebalances the whole move. This is the part of inefficiencies and imbalances which we'll cover in the next videos, but this is a good thing to know. So there are like many different things to remember in the market cycle thingy. But to put it out simply, once the point 0.5 is touched, you should expect a next cycle, right? That's the first thing. The second thing for me is that if even if the point 0.5 is touched, price could still go lower. It can obviously go higher, but there are times when it can definitely go further lower. And what is the best point of the market cycles to be completed? The 618 to the 886 region. Anywhere in this is a very solid disbelief part, like the depressional stage of the market cycle with respect to that specific candle. So at point 0.5, it's rebalanced. At 618 to 886, the cycle is complete. And then we can expect higher if we have to continue bullish or we have to continue the trend. So, nonetheless, again, this is the same thing that we see on the next leg 786, 886, boom, goes back up, and well, it's just like a lot of legs. And you guys probably now understand why I am teaching you this. It's not to trade this, it's to know whether the price has completed its objective of the price delivery or not. So this was the emotional market cycle or the psychology of market cycles. And you'll be amazed that this works everywhere on every sort of price action. And this is why basically your Fibonacci sequences or the Fibonacci retracements work, because it's tied to the psychology of the market. Hopefully you guys understand, and this gives you a new perspective in terms of price and how to read it. And there is also one more thing that I actually want to teach you. So there is one more use of price, what I want to teach you. So in this case, I will just be using 0, 0.5, and 1, whatever you want to call it. What you want to do is know the premium versus discount. This is a sort of like a important and not that important, but it's useful to know because you will see traders use this in very simpler examples. So the case is anything above zero point 0.5 on a leg, right? From 0 to 1, anything above the half of this whole leg is called premium. And anything below the zero point 0.5 is called discount. The general theory of this is that if you are going long, right, if you are in buys, you generally want to buy below the 0 0.5. If you want a long, you should long over here. Why? Because obviously there is a zone in this place. There is some sort of a zone here. More buyers are present. If they want to continue higher, more buyers are present and they will probably take the price higher if the trend has to be resumed. And obviously, the next cycle has to start. And if you are trying to trade retracements, right, you should be selling in this premium region. This is the premium and this is the discount. Above 0.5, this is the premium. And above and below 0.5, that is the discount. So if you want to sell above here. And if you want to buy below the 0.5. Why? Because in this case example, we have pumped a lot. We have pumped a lot. So it doesn't really make sense to buy up here and pray for continuation higher. Where would you place your stop loss? Over below this level, because that is the most logical point, or below this level. So if you do that, you have a pathetic risk to reward ratio from buying over here, targeting this high, stop loss over here. Not a good thing. But in case you're selling, you try to trade the price back into somewhere over here. Your stop loss in this case goes above this high, and you can target this one. So that is a good general thing. Don't long in the premium and don't short over here. Just go by these rules. Anything more than this is not important. Trust me, it's not important. All you need to know is that you don't buy over here, you don't sell over here. And that's about it. So I'll see you in the next lecture. Hopefully, you guys understand this. I really want you to go and chart this out and post your results, what you find. If you have any questions, post it in Discord in the university section. I'm there to help you out.